Welcome back to our weekly update. I'm Charlotte McLeod with investingnews.com, and we're going to run through a few of the week's biggest stories in the mining industry. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and of course, leave us a comment below. Let's get into it. It was a bumpy week for the gold price, which dropped as low as $43.70 per ounce midway through the period before rebounding back above $4,500. Silver put on a similar performance, bottoming out at $72 per ounce. Both precious metals were reacting to a complex array of dynamics, including the latest Iran war developments. The situation continues to fluctuate, and the declines in gold and silver came as the US and Iran exchanged attacks, despite the ongoing ceasefire. At the time of this recording, the two countries had reportedly reached a deal to extend the ceasefire by 60 days and start negotiations on Iran's nuclear program. However, neither side had officially confirmed acceptance, meaning the deal may not hold. The rise in hostilities boosted the US dollar and oil prices, which increased concerns about inflation and discussions around higher interest rates. The release of the latest US personal consumption expenditures price index data also contributed to rate conversations. PCE rose by a seasonally adjusted 0.4% month-on-month in April and 3.8% from the year-ago period. That's the highest since May 2023. Core PCE, which excludes the food and energy categories, was up 0.2% on a monthly basis and 3.3% from the same time last year. Core PCE is traditionally the Fed's preferred measure of inflation, meaning that market watchers use it to gauge what could be next for rates. In a potential shift, Kevin Warsh, who's taken Jerome Powell's place at the helm, prefers to look at trimmed averages. That approach removes more volatile activity, but analysts have suggested that it may not provide an accurate picture of what's happening. Going back to gold and silver, were this week's lower prices just a blip on the radar, or do they signal the start of a summer slowdown? I heard from Ronald-Peter Stoeferle of Incrementum, who said that in the near term, he thinks investors shouldn't expect too much from the precious metals. Here's how he explained it.
I think that we're seeing some sort of a lack of immediate catalysts. We're seeing some headwinds. We're seeing very weak seasonality. But we're already seeing that, lots of negative sentiment in the market, especially in the gold and silver miners. So that makes me confident, but I wouldn't expect too much for gold and silver over the next couple of weeks. Probably after the World Cup is done, I think then perhaps there's going to be more upset, but that's just correlation, no causation. Historically, midsummer, somewhere end of July, beginning of August has often been kind of the bottom for gold and silver, and especially the minings.
Looking longer term, Ronnie's outlook is much stronger. He believes this is a golden decade for gold and said that the metal is on track to meet his target of $8,900. Speaking of seasonality, I also heard this week from Justin Hune of Uranium Insider. As always, he gave a great overview of uranium's supply, demand, and price dynamics, emphasizing his bullish long-term outlook. But Justin also said the market's cyclicality makes it very tradable, and right now could be a good time to buy low.
This is a very tradable market, and over the years, we've had amazing success with trading when it comes to understanding the robust support on the fundamental side for the physical market for the mid and the long term. And when you have near-term, short-term pullbacks, you kind of know what to do. And it can be difficult to put money to work when the sector has pulled back, when the volatility is high, when sentiment is very, very poor. That's the time when you actually want to be buying. And it can be difficult to do that if you don't have a strong foundation and a strong outlook for what's coming in front of us. So you have to understand the physical market more than anything in order to have that conviction, in my personal opinion.
I'm curious to know if you take seasonality into account when you're investing or if you're focused on longer lasting trends. Leave us a comment below to share your thoughts. On the topic of uranium, major miner Cameco has resumed full production at its Key Lake Mill and McArthur River Mine in Saskatchewan. Operations were disrupted earlier this month by the partial collapse of a bridge in the area. It serves as the company's primary transport route for essential operating materials. That route has not yet been restored, but Cameco said it's been able to use a secondary pathway to consistently deliver those materials. Although the incident had raised questions about Cameco's 2026 guidance, the company said its production expectations remain unchanged. The Iran war continues to impact a wide variety of commodities, and this week aluminum was in focus as London Metal Exchange prices reached their highest level in 4 years. The conflict has resulted in a global shortage of the industrial metal, with smelters in China working above their capacity to take advantage of the supply crunch. Now, however, traders are concerned about output cuts in the Asian nation amid government inspections focused on energy use and emissions. Sector participants are projecting that Chinese exports of the metal could hit a record of over 680,000 metric tons in the months to come, after rising 15% in April.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.